Good afternoon and welcome back everyone to the second session of our trading summit focus on leveling up your options, where we're talking about how to go from hitting singles to doubles. This is a expansion on our previous session where we covered the foundations of options trading, where we covered the basics of buying versus selling options. What are the pros and cons of each one? And today we're going to talk about how we can take those four basic strategies and how can we expand on them? How can we maximize those strategies and actually take on less risk? We all want to maximize our return, but how do you actually go about doing so? The key way to doing so is actually minimizing risks. We're going to talk about how when you go from hitting singles to doubles, you can minimize risk and maximize your overall return. We have a lot to cover here today, so let's go ahead and jump right into it. But just a reminder, OptionsPlay education sessions every single Thursday is designed to help empower you to become a self-sustainable and confident trader. You can do so by making sure that you round out your education, not just on technical analysis, not just on options trading, but also things like how do you build your emotional resilience to become a successful trader. And that's what we are here to teach day in and day out. And every single trading summit tries to round out your education. So you're not just focused on one aspect, that you really have a well-rounded education to help you become a sustainable and confident trader in the long run. Now, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So we're going to be covering the introduction to vertical spreads. Vertical spreads are two-leg strategies, and they are effectively a variation of what we learned last week. When you buy a call or a put, or when you sell a call or a put, those are still going to be the primary drivers of these vertical spreads. But by trading a vertical spread, what you do is you reduce your risk relative to those four core strategies, and that's going to amplify your returns. So we're going to talk about in the context of debit spreads, or we're going to talk about in the context of credit spreads. We'll go through each one with examples and outcomes. We'll run through this fairly quickly and really show you the difference between buying a call versus a debit spread, or selling a call and selling a debit spread. At the end, I'll show you a cheat sheet just to help you reference all the things that you've learned here today. And at the very end, I'll open this up for Q&A with some examples. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I minimize risks and maximize profits by leveraging these multi-leg options trades. So what I want to do is I want to just remind those of you that are joining OptionsPlay for the first time to first of all chime into the chat window. I see a lot of you have already chimed in and said, where you're joining us from. If you're joining us from the first time, please feel free to chime in and let us know who you are, where you're joining from. I saw a lot of places that are from all over the world, from Germany to Pakistan to I saw a few from Europe. Most of you obviously from North America. Welcome, welcome, welcome. Thank you so much for joining us this afternoon, and thank you so much for our members for supporting us and allowing us to continue to do this. If you're joining us for the first time, a lot of questions that we get as, how can I get access to the recording? How can I get access to the slides? You can get all of it if you simply either have a membership with OptionsPlay or if you start your free trial at optionsplay.com/signup. Posted a link here in the chat window, help you get set up if you don't have an account yet, or you can point your phone to the QR code. Takes literally 10-15 seconds to sign up. That will trigger your free trial access so that you can get access to the recording, the slides, as well as the platform that I will be showing you during today's session to show you how you can implement the debit and credit spreads that I'll be showing you during today's session. So all of that is included if you have your free trial. So start that today. If you are joining us for the first time at optionsplay.com/signup, you can either click on the link into the chat window or point your phone to that QR code on your screen here right now. So let's talk a little bit about vertical spreads. It's a simple strategy, and there are many variations to it. So I want to make sure that you understand how to go about doing so. So let's first discuss what a vertical spread is. It's a limited risk strategy to take a directional view on the market. So last week, we talked about long calls, short calls. What the difference is, they're both directional trades, but they have very different kind of outcomes, right? So a vertical spread is the same thing. It's really just a variation of long calls, short calls, long puts, and short puts. They can be suitable for either mild or large directional bullish or bearish trade outlooks. Same thing as the single leg strategies. But they typically provide better liquidity due to the limited risk nature of them. What do I mean by this? When you buy a call option, the market maker on the other side of the trade has to be short a call option as a result of that trade. And what that means is that they're taking on a trade structure that has unlimited risk. Vice versa, when you trade a vertical spread, that has not only limited risk for you, but it also has limited risk for the market maker on the other side. So market makers are obviously going to be a little bit more willing. Now, they're not unwilling to take on unlimited risk because they offset that risk, right? And many times they have other buyers so that they can offset the risk too as well. But because market makers know once they trade a vertical spread on the other side of a vertical spread, whether you're buying or selling, they have the same limited risk as you do. There's generally better liquidity when you're trading a vertical spread than if you're trading a single leg. Now, that's not very obvious to a lot of traders, but it's one of the additional benefits that on the execution side, many times you may find an easier time executing a vertical spread than you would on a single leg strategy. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. So we're going to start off with our debit spreads. So you have debit spreads and you have credit spreads. They both fall under the umbrella of vertical spreads. We're going to cover debit spreads first because they are a variation of the long call. A debit spread is basically improving the long call and long put by making a little, by reducing the overall risk and having some specific outcomes for it. So a debit spread, just like a long call, allows you to leverage your capital for a stock or ETF that you believe is going to have a strong directional view. Last week, we talked about the fact that if you want to buy a call or a put, you better believe the stock is going to make a sizable move for you to overcome the premium or the break-even price of that overall strategy. With the debit spread, that's the same outcome. It's just that you'll see that you have slightly better risk to reward with the debit spread, and you have a lower amount of risk that you're taking on when you're trading a debit spread. So this strategy provides leverage for a strong risk to reward, but requires you to pay time decay. Whenever you're paying for options, that's a hump, if you will, that you have to overcome before you're profitable. And what we're trying to do with the debit spread is we're trying to reduce that hump by as much as possible so that, one, you have a higher probability of profit, you have to outlay less capital to get into the trade, and your maximum risk on the trade is reduced as much as possible. But overall, when you're trading a debit spread, you have limited risk and you have limited reward. So let's look at an example here. I'm going to look at Marriott. And it doesn't really matter what stock you're looking at, but I was recently looking at Marriott. It recently has rallied, but started to turn, from the rally, has kind of lost some ground in that rally and started trading sideways. And there was a risk that it was starting to break below some support levels. Momentum had turned negative, and maybe, Marriott could start reversing lower. And I thought that if it did reverse lower, it could reverse as low as into the 180 level. So that's just a technical setup that I saw here in the market that I wanted to play. So because I felt that the move to the downside, if it broke that support, was sizable, right? It could be a big, fast move when it breaks that support level. I'm going to use a debit spread structure. So here's how I constructed that debit spread. And I used OptionsPlay to construct the debit spread for me. And I'll show you in 1 second how you can replicate this type of trade structure for any idea that you have, right? I'm just using Marriott in my example. I'm going out to the November expiration. That's roughly 2 months from now. The general rule of thumb when you're trading these types of long options, whether you're buying a call, buying a put, or buying a debit spread, is to generally start your research going out about 2 months from expiration. And what I'm doing here is I'm going to buy a $200 put. This is what we learned last week. When you have a bearish view, you buy a put option. But as you can see, if I bought the $200 put, I would pay $7.75, which means that I have to believe the stock is going to go below roughly 193 or so in order for me to be profitable. It has to actually decline below 193. It has to go to about 192.25 before it's profitable. That's $200 minus the $7.75 that I have to pay. So I really have to believe the stock is going to be, well into the 180s in order for this to be profitable. Now, that's reasonable, right? Because I think the stock can go down to as low as 180. So it's definitely a trade that I might consider making. But here's what a vertical spread does. What I'm going to do is I'm going to sell a 180 put against it. I'm not just going to buy the 200 put because keep in mind, I think the stock's going to move lower, but I don't think the stock's going to go to zero, right? When you buy a put option, what you're doing is you're paying for the downside exposure all the way through zero. So you're the 775 you're paying for the possibility that Marriott could drop well below 180. But what if I don't think that's necessarily going to happen, especially around the timelines, that I have here, which is November? What you can do here with options is not only could you be a buyer of the option, you could also at the same time be a seller of the option as well. So if I sold the 180 put, I collect $2.38. That means my net debit on the trade now goes down from 775 to 537. So as you can see, if the stock drops, what I'm able to do is I'm able to significantly reduce the amount of risk that I have to take in this overall trade in exchange for giving up any downside below 180. That's the trade-off that you're making when you're trading a debit spread. You're trading off gains below a certain price in exchange for some premium. Now, how much premium is it? Let's take a look at this example. 230. I'm collecting $238 versus the 775 that I'm paying. I'm reducing my overall risk here by roughly 30%. That's a significant reduction in overall risk. That means I have to put up 30% less capital to get into the trade. And that 30% reduction is going to see some significant gains in returns if Marriott was to decline in value relative to buying that put option. I'm going to show you some of those changes here in 1 second. But before I move on, does everyone understand what we're doing here? By selling that 180 put, I'm collecting premium and I'm reducing my risk by 30%. In exchange, I'm giving up any gains below 180. If that makes sense to you, please type 2 into the chat window if that makes sense to you. Perfect. Okay, so at this point, what I'll do is before we jump into and looking at kind of how this plays out, I'm going to bring up the OptionsPlay tool because the OptionsPlay tool is really designed so that if you have a bearish view, right, whether it's Marriott or any other stock, I'm looking at Starbucks here for 1 second here today. If you have a bearish view on a stock, you can type in the symbol into OptionsPlay and select I'm bearish here on the upper right-hand side for trading. And we will present to you three bearish strategies to take advantage of a bearish view on any stock that you type in. Right, so you can type in a stock, you can look at technical ideas. If you want to screen for some bearish ideas, if you want to look at watch lists for some bearish ideas, you can do so, or you can type your own strategy. Whatever symbol you land on that you have a bearish view on, you just click on I'm bearish here on the right-hand side of your screen, and we will present to you both the put option and the put spread, the debit spread next to it, so that you can compare the two strategies and see side by side what is the difference between the two, right? I'll go back to Marriott just so that we can compare apples to apples. Now, I put those slides together yesterday before the open, so we will likely see different prices right now. But let's say I'm still bearish here on Marriott. I'm going to look at buying maybe a 200 put. I'm gonna modify this just because we're trading right around 200. So let's look at buying the 200 180 put spread. So buying the $200 put would cost me $6.20. Buying the put spread would only cost me $4.40. Now this is based on current closing prices. So let's do that math again. 620, I believe it was 620 minus 440. That's a difference of $180. So $180 out of 620, that's a savings of similar 29%. Instead of 30% right now, it's 29%, right? So I'm able to reduce my overall risk when I buy that put option versus the put spread by 29%. And I want to show you what that 29% does in the grand scheme of things. So let's go back to our P&L simulator. So let's say Marriott does drop, right? Let's say it doesn't drop all the way to the $180 level. Let's say it drops to 190. Just to give you a sense for the difference between the two. If the stock drops down to 190, as you can see, my put option that I purchased is up $380, which is roughly a 61% return on capital. Not a bad outcome, right? You know, considering it didn't fully reach my target, my full target at 180, I'm getting a pretty nice return of 61% on the capital that I've risked. But as you can see here on the vertical spread, because I've reduced my overall risk and the capital that's required to get into the trade by 30%, look at how big the returns are amplified by reducing that risk by 30%. I'm making a 560% return, but because it cost me significantly less to get into the trade, my return on this is 127%. That is the difference between buying a single versus a double. You know, we usually think of singles to doubles. It's not a huge difference, but as you can see here in this example, there's a major difference that you can see even at a 30% reduction in the overall risk of the trade. And 30% reduction in terms of going from single leg to double is pretty, I would say, average. You know, you can definitely find sometimes where you get 35, sometimes even 40% reduction in risk. That's not as common, but 30% reduction in risk by going from single leg to double, from singles to doubles is not uncommon to see. And it has a dramatic effect on the overall return on the strategy if you are able to reduce your risk by that amount. Now, there's a trade-off here. The trade-off is that if the stock declines down to 180, well, at 180, you'll still have a pretty dramatic outperformance here in the debit spread. But the trade-off that you're making is that if the stock declines further, right? So let's say the clock decline, let's say it goes down to 170, it exceeds your expectations. As you can see, this put option gives you unlimited gains to the downside. You can make 383% return. But notice in this particular case, even when you exceed the downside strike by a fairly significant margin, right? We thought it was going to go down to 180. It goes all the way down to 170. As you can see, the two performance is still very similar. That's just how big of outperformance that you get, that even when you exceed your initial targets to the downside, you're still coming out very similar in terms of the two outcomes. Only if it continues to drop further, right? Are you basically at this point capped at 350% return on your debit spread, but your your long put can continue to make more and more money to the downside. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Okay, and this platform allows you to do it for any symbol, for any directional trade. So let's say you pull up, I don't know, let's say you're looking at Alphabet. Maybe in this particular case, you're bullish on Alphabet. You can use the OptionsPlay tool, type in the symbol, select I'm bullish here, and be able to see, okay, what's the difference between buying a call option to buying a spread, right? Right now, I'm looking at the November 135 call versus the 135, 155 call spread. Now, we've already optimized the call spread for you. That's the beauty of this. We've selected the expiration date, the strike prices for you based on what our best practices for selecting this. We're selecting a strike price that's roughly 1 standard deviations away so that the chances of the stock exceeding that second strike price is only about 15%. So even if it does go beyond that strike price, you're not likely to underperform the long call by very much. So as you can see here, if the stock were to rally from 135 to let's say 145, right? Here, I'm making a 14% return on the call. I'm making a 32% return on the spread. If it goes up to 150, I'm making a 72% return versus a 99% return. So here, as you can see, the difference is not as big, right? Because the difference between these two savings are not as great. But you still get some savings, right? So 753 minus 870, that's a difference of $117. $117 out of the 870 that I'm paying. Here, as you can see, I'm only getting about a 13% discount. So as you can see, the difference between a 13% discount versus a 30% discount is pretty significant, right? Here, instead of making a 72% return, I'm making a 99% return. But it's still the same in terms of, by reducing risk, you get a higher return when the trade goes in your favor. So if it does reach that 155 level, here I'm getting 130% return versus 165% return. So as the trade goes in your favor, you're going to be more profitable. And even if it exceeds your upper strike, right? Let's say it goes up to 160. Here, I'm making a 187% return. But still, as you can see, because I'm ahead on that vertical spread, I'm not underperforming by very much, even when it does exceed my upper strike. And vice versa. More importantly, if the trade doesn't go in the direction I expect it to, I'm always going to lose less on the vertical spread than I do on the long call, which is why the options play score on the debit spread is always going to be higher, because when the trade goes in my favor, I'm going to make a higher return. When the trade goes against me, I lose less money. And the options play score gives you a sense for the probability weighted risk to reward ratio. What are the outcomes if I'm right? What are the outcomes when I'm wrong? And which one gives me a better outcome in all possible scenarios? That's what the options play score does. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you as to how you can use the options play platform. Type in any symbol that you have a bullish or bearish view on, and very quickly, within a couple of seconds, know what are my starting points if I want to trade a single leg? What are my starting points if I want to trade a double, a vertical spread? And how do I compare the two by looking at different scenarios, if it goes higher, if it goes lower, and being able to be clear as to which structure that I want to trade. And if you're brand new to options trading, make sure you click, or if you're brand new to vertical spreads, click on the trade button and add the trade to some kind of paper trading portfolio. You can set up as many portfolios in options play as possible. And if you want to just paper trade this trade in Alphabet, click on add positions, create a paper trading portfolio for yourself, click on add position, and then you can always go to your portfolio page and look at your open positions in your paper trading portfolio. And you can track all of the trades in your paper trading portfolio and see, okay, this Alphabet trade that I just entered, here's how it's doing over the next few weeks. Track it. Maybe you can even set up a call option and a vertical spread and see how the two perform side by side. This is how you learn as a trader and start leveling up your options. I know many of you are already trading these vertical spreads. Last time we asked you these questions, about 60% of you are already trading vertical spreads, but 25% of you said that you're still trading single leg options. If you're trading single leg options, this is how you can potentially level up using the tool, creating these strategies, testing them out if you need it with a paper trading portfolio at first, and making sure you understand them before you execute these trades into your platform. Okay, so that is at a very, very high level, kind of what a debit spread does. And I can walk you through these scenarios, but that's exactly what I just did right now with the P&L simulator. And I think it's always better to look at real examples rather than on a slide. So I'm going to skip over these scenarios and I'm going to jump right into managing these trades, because last time I did one of these sessions, there was a lot of questions around how do I manage these trades once I'm in. The rule of thumb for debit spreads are quite simple. There's really two numbers that you want to think of from a percentage perspective: 50% loss and 75 to 100% gain, because those are the thresholds, generally speaking, where you need to do something with your debit spread. At 50% loss, meaning if, let's say, you paid $10 for a debit spread, right? Before we were paying $7.75, but I'm going to use a round number here. Let's say you paid $10 for a debit spread. Once you lose 50% of what you've paid, chances are, whatever views you had in the market, it's not working out. It's time to cut your losses and move on. There's no ifs or buts. There's no maybe sometimes you can do this, other times you do that. There's no ifs and buts on the downside. When a debit spread does not go in your favor, you do nothing else other than simply close it out. You don't hold on to it for longer. You don't try to hope that it comes back. And guess what? Sometimes if you did hold on, you do make it back. And sometimes you think you're smart, but by not following your own rules, you're the one that loses out in the long run. You may have one or two trades that do work out for you in the, here and there, but in the long run, the person who's losing out is yourself because you're not following your rules. When you don't follow your rules in the long run, that's going to come back to bite you in the ass. So when trades lose 50% of the premium that you pay, get out of the trade. So, and the OptionsPlay portfolio is designed to to allow you to very quickly see where you currently stand on all of your positions, right? If we take a look at our daily play portfolio, the way that the daily play portfolio is structured, it gives you the P&L percentage here so that you don't have to really look at the position very much. You can just see what the P&L is from a percentage perspective and quickly make a decision as to whether or not you've met one of those thresholds, right? You can use this to track your TD portfolio. We have a portfolio sync. So you can automatically sync OptionsPlay to your TD portfolio. That's going to move over to Schwab. So for those of you that have a TD and Schwab portfolio, you can automatically have OptionsPlay track your portfolio. We try to make it as easy as possible so that you can see how each position is doing, what the percentage gain and loss is, so that within a glance, you know which positions you need to do something with, right? That's how I manage the daily play portfolio. That's how I stay on top of, all the different positions that I have in my personal portfolio and the daily play portfolio and other portfolios, is I use the portfolio tool to help me do all of that. So the rule of thumb is once you paid $10 for something, once it loses 50%, get out of the trade. There's no ifs or buts. If the trade goes in your favor, that's where you have a lot of options. There's a lot of things that you can do when the trade is working in your favor. Generally speaking, you want to potentially exit at least half the position, somewhere between 75 to 100% gain. But that's really where you have the option of adding to that position, either changing the expiration date, strike prices, moving the strike prices, as the trade moves in your favor. There's a lot of variations. I've covered a whole course just on kind of how adjustments you can make when a trade is working in your favor. But generally, once you make 75 to 100% gain on a debit spread, it's time to do something. It's time to either take some profits, roll it, add more to the position. We certainly have a philosophy that when trades go in your favor, it's an opportunity to add more to the position because the market has effectively proven your outlook or your view to be correct. Now is not the time to reduce exposure. Now is the time to potentially add exposure. But the question is, when do you go about doing that? At about 75 to 100% gain is when you can start looking at adjusting a position. Does that make sense, everyone? Please type 1 into the chat window if that if that makes sense to you. And there was a question as to why don't we get out of these? These actually hasn't been updated. As you can see, the mark on these are still blank. That's why these have not actually lost 100%. I'm waiting for this to update. Right now, I'm having some issues with my internet here right now. But the reason that we haven't exited those two is because they actually are not at 100. We're just waiting for those prices to update. And until they update it, it's assuming a zero price. And that's why it's showing a 100% loss, but it's not actually down 100%. Our Apple trade is actually profitable. And I believe our AMT trade, as you can see now, it's been updated. Apple is up 14% and AMT, I believe, is also near flat. It's down 6%. So as you can see, none of these have reached our take profit or stop loss level. And this one is not. This is a short trade, which follows different rules. And we'll go through what those rules are for credit spreads. But that also has not reached any of our threshold levels. So, the portfolio tool is incredibly helpful in helping you stay on top of a portfolio and know where you stand. But the rule of thumb as far as when do you take action is 50% when you're to the downside, no ifs or buts. When the trade goes in your favor, 50, 75, 100%, you really have to start doing something with that. But there's a lot of different variations. And like I said, I teach a whole course just on what can you do to adjust your winners when they become winners. Okay. Let's now move on to credit spreads. So debit spreads are for making a better version of a long call or a long put. Credit spreads are a better version of a short call and a short put. And we actually talked about this last week. I never recommend ever for you to sell a naked call option, because selling a naked call option has the same unlimited risk as being short the stock. And we've all seen what happened with GameStop last year. You don't want to be caught in that situation. So never ever sell a naked call option. You can sell a naked put because there's, the stock can only go to zero, and many times you're selling a put because you want to own the stock, but never sell a naked call. So a credit spread basically gives you the income that you receive from a short put or a short call. But when you do a short call or a short call, number one, you're taking on a lot of risk to do so. It requires a lot of capital to sell a short call or a short put. So what you want to do is a credit spread allows you to take on the same risk profile, but significantly reduce the amount of capital required to get into the trade. So I'm going to use Starbucks here for an example, and I'm using Starbucks because while I have a bearish view in terms of Starbucks, my bearish view is somewhat mild, right? As you can see, this is trending, it's a slow grind here to the downside. It's not one that I'm thinking that this is going to break a support level. It's going to make a big move lower. But I certainly think that on rallies, it's an opportunity that you get another slow grind lower. And that's an opportunity to sell something like a call option. But like I said, I never would want to sell a naked call. So what do? In this particular case, when you're selling options, you generally want to go slightly shorter dated. And when you're buying options, you want to go longer dated because time decay is working against you. When you're selling options, time decay is working in your favor. So you want to go a little shorter dated. So here I'm going out to October 27th, and our platform automates this work for you, right? It selects the expiration date automatically for you. And what I'm going to do is at the time when I put these slides together, Starbucks trading at just shy of 97. So what I'm doing here is I'm selling a $97 call option. Here I'm collecting $2.77. But here's the thing. I'm collecting $2.77, but I'm taking on unlimited amounts of risk, and I have to post tens of thousands of dollars of margin. I'm sorry, thousands of dollars of margin in order to get into that trade and collect $277 of income per contract. That, in my opinion, doesn't make a lot of sense. You have a lot of potential risk. You're putting up a lot of capital to make $277 in potential income. So what I'm going to do is I'm going to do something simple. I'm going to buy a call option against it. I'm going to buy a 102 call option against it. And by doing so, I'm reducing the amount of credit that I'm receiving, right, from $2.77 to $2. I am reducing the amount of income that I'm collecting, but I'm reducing my overall risk to just $300. And we've discussed this in previous sessions on credit spreads, but the distance between the two strike prices, 97 and 102, that's $5. If I collect $2 out of those $5, $3, the rest of it is my total risk. So whatever I collect in income, the rest of it is going to be my risk. So here I'm collecting $2. So the $3 that's remaining in the $5 vertical spread is going to be my total risk. So I've reduced my capital that's required to get into the trade from a few $1,000s down to $300. And I'm reducing my overall risk from fully unlimited risk down to $300. And in exchange, I'm giving up the 77 cents worth of income to do so. And that's why whenever you're thinking about selling a short put or a short call, you might want to consider a credit spread, because if it significantly reduces the amount of risk, significantly reduces the amount of capital required to get in exchange for a slightly lower income. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. So let's look at an example like, let's look at Starbucks. I'll pull up Starbucks here in 1 second. My computer is just not cooperating today. Let's see if I do a refresh, if I get this working a little bit better. Okay, let's see, Starbucks. So my view here is that Starbucks, slow grind lower here. You got a small rally here, but small rallies are opportunities to sell. And that's kind of what we're seeing here, right? And because I don't think it's going to be a big move, doesn't make sense to be buying options. I'd rather be selling options because selling options are profitable even when the stock doesn't move. So here, what I'm going to do is I'm going to go to high implied volatility strategies because you generally want to sell options when volatility is higher. And this is really where we're going to see the debit spread. And I'm sorry, you're going to see both bullish credit spreads and bearish credit spreads. So our platform automates both for you. So regardless of whether you want to be selling a bullish credit spread or a credit spread, the platform automates both of that for you. So as you can see, because Starbucks had moved up a little from 96 to 97, we're now selling the 98.102 call spread versus the 97.102 call spread. And just to show this to you, what I'll do is I will compare it to selling, the 98 call option, right? So if I sold the $98 call option, I'm collecting $2.15. If I'm selling the call spread, I'm collecting $150. So I am reducing the amount of premium that I'm collecting from $2.23 down to $1.50. But keep in mind, my max risk here is unlimited. And to sell a call option, a naked call option on a $100 stock, I'd probably have to post somewhere between $2,500 to $5,000 in margin just to do so because I have unlimited risk. The brokerage firm doesn't want you to take on unlimited risk without knowing that you have the capital to pay for the losses if they do materialize. Right? Versus here, my max risk is $250. So the brokerage firm is only going to ask that you post $250 worth of margin in order to get into the trade. So as you can see, I'm reducing the amount of capital that's required to get into the trade by nearly probably 10x. Right? You're going from $2,500 to $250, which means that number one, you could probably afford to sell more contracts of a credit spread than you could on just a short call in exchange for giving up, in this particular case, about 70 cents worth of income, $70 per contract, but you're able to, in theory, trade 10 times the number of contracts by trading the credit spread versus just outright selling the call option. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And when we look at the P&L simulator, when we say, what happens if the stock stays where it is? As you can see, your profit is virtually, or your risk profile is virtually identical between the two. You're just making 70 cents less profit with the credit spread than you do with the call option. You do have a little bit more upside protection as you can see, if the stock increases in value. So this is obviously a bearish spread, but one of the benefits of a credit spread is that even if the trade goes against you, you can still be profitable because whatever you collect in premium, that's a buffer that you have, right? So even if the stock increases in value instead of decreasing in value, you have a buffer where you can still be profitable before you lose money. And that buffer is going to be a little different because in one scenario, you're earning about 70 more cents. So you have about a 70 cent more buffer on the outright call option versus the credit spread. So if the stock increases to 99.5, you'll still be profitable if you sold the short call. You'll be at break even if you sold the credit spread. Now, if the stock, if it increases in value, as you can see here, let's say it goes up to 102, here I'm losing $250 versus $177. Again, very similar in terms of risk profile. Where things really kind of get out of hand is if, let's say, Starbucks, for whatever reason, has a good earnings announcement or some product comes out, releases kind of pumpkin spice lattes are selling significantly better this year than last year, and some positive news comes out. You never know when that happens. This is really where the losses that you can experience on the short call is unlimited, right? Here, I'm already losing 360% of what I've collected. Here, I'm only losing 166%. That's the maximum I can lose. $250 is the most I can lose. I cannot lose more than that. So you have full control over how much you lose. And as long as you trade the correct number of contracts, such as using the risk and investment calculator, you know that your losses will never exceed your maximum loss. So let's say I sold 8 contracts because I don't want to lose more than $2,000. Well, even if the stock goes all the way to 1,000, I'm only going to lose the $2,000 that I'm willing to risk on this particular trade. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. And just like this, OptionsPlay is designed so that regardless of what symbol you have a bullish or bearish view on that you're thinking about selling options on, let's say you're looking at, let's go back to Alphabet again, right? Maybe you're bullish on Alphabet and you're thinking instead to be an options seller instead of an options buyer, you click on the high implied volatility strategy here, and it will set up the trade structure here for both the bullish and bearish credit spread. You can compare it if you want to just outright selling the put option. So instead of selling the 138 put where you're collecting $405, the credit spread here, as you can see, you're only collecting $196. So here you are giving up a lot of potential income in exchange for limiting your losses, right? And you have to ask yourself whether or not that's worth doing so, or maybe in this particular case, you might just want to sell that outright put option, or vice versa. If you're bearish, how does that play out in terms of, here, as you can see, selling the call option, I'm generating $538 worth of income versus the call spread, I'm generating $370. Those two numbers are closer to each other. So, but you can use the P&L simulator to actually see how much potential gains that you can make, how much potential losses you can potentially have, and be able to weight these two against each other and decide which one's best for you. And just like the debit spread, if you're new to these, put them in a paper trading portfolio. Click on add position, and you can track these positions in your portfolio and see how they're playing out. As they play out, you will have more confidence in understanding how they're working, and as you do that, you'll be able to actually track these trades and see whether or not you have that understanding, and the portfolio tool is there to help you track it, and also show you the P&L so that you can decide when to take action. Okay, so with that, same thing. I'm not going to go through the outcomes because the P&L simulator allows you to do them live with any of the actual positions that you might trade. So let's talk a little bit about managing credit spreads. This was a common question that I got in the last credit spread session, was when do you manage these spreads? And with credit spreads, they get a little bit more involved because there are two exit strategies, one for take profit, one for stop loss, and there's a third one for time. Because whenever you're selling an option, you have the obligation to buy or sell the stock that the buyer of that option has the right to exercise at any time. So there's an additional risk element whenever you're selling options that you don't have when you're a buyer of the option, because as a buyer of the option, you have that right. As a seller of an option, you have to take on the obligation. So you have to factor that into your decision-making process as you manage these credit spreads. And generally speaking, when you're selling a credit spread, you're just trying to take a directional view. You certainly don't want to be the owner of a stock or being short 100 shares of that stock for each contract that you own. So when you're managing credit spreads, you not only have to manage your own P&L, you also have to manage the risk of being assigned. So that's why we're going to break it down into two sets of rules. The first set of rules is your P&L. Rule of thumb here is that if you lose 100% of what you can potentially make on the trade, it's time to get out of the trade. What do I mean by that? If, let's say, you have a credit spread that you collected $8 on, right? You collected $8 in potential income. That's the most you can make. If you were to lose $8 on that particular trade, it's time to get out, and so that you never exceed more than what you can potentially make on that trade. So meaning if you sold something for $8, you want to set your stop loss at $16, because the difference between $8 and $16 is the other $8. That's when you want to get out, right? So if you sold something for $8 and now you have to buy it back at 16, that's your rule of thumb, where you have to take your loss and move on. If you have to buy back a credit spread at 100% more than what you collected, that means the trade's not working in the direction that you expected to, and it's better off for you to get out of the trade and not lose the other rest of the $4 that you can potentially lose on this particular trade. Just get out and at least save yourself some premium that you can have left to apply to the next trade. Does that make sense, everyone? Please type what number are we on? Please type 5 into the chat window if that makes sense to you. And like I said, when a trade is not working in your favor, there is no ifs and buts. You close out the trade. You don't think about it a second more. If you deviate from these rules, like I said, sometimes it works out for you and you think you've outsmarted the market, but I guarantee you in the long run, when you don't follow your own rules, the only person that's losing out is yourself, because more often than not, you're just going to end up losing the other $4 and you're going to come out in a worse position. And, as I always say, when profitable trading is very simple in concept. Keep your losses small, keep your profits large. Most of the time, what we end up doing is these things that we do that we think we're outsmarting, the market. What we're really doing is we make the losses larger than we normally anticipate them to be, and then our gains are smaller than we anticipate them to be. Right. So stick to your rules. The rules are there for a reason. Make sure that when the trade loses 100% of what you can potentially collect. So looking at Baidu, right? Looking at this Baidu trade. In the debit spread, in the daily play portfolio. Baidu, as you can see, is down 64%. We collected $3.64 on this credit spread. It's now trading at $6. So we haven't lost 100% of the premium that we collected. It's getting there, but it's not there yet. And this is kind of what I mean in terms of the portfolio tool. That one number, the percentage P&L, is very quick for you to be able to say, okay, I'm at a threshold or I'm not at a threshold. Let me manage it, or this is okay to remain in the portfolio, right? So this is how I look at the portfolio every single day. I look at that one number, and that's the one number that I need to know. Do I have to do something with these positions? On the other hand, if a credit spread makes 50% of the premium, it's time to consider taking some profits off the table. Now, like I said, when you're taking profits, you don't want to just take profits. You want to also think about, should I add more to this position? Should I sell a new credit spread? So let's say I sold something for $8, and now that $8 credit spread is trading for $4. That means I've made at least 50% of the total premium that I can potentially make. Now it's time to do something. You can roll it, you can take some profits, but if the market has proven your directional view to be correct, think about adding more exposure, right? Take some partial profits, but put that position back on. Sell another credit spread. Try to keep moving that chain down. That's what we've done with UPS this whole week. Last week we entered, we've been short UPS for quite some time on the break below 180. Once it got to that 165 level, we sold another credit spread. Once it got down to 160, we sold another credit spread, and we finally closed out the last credit spread earlier today. The idea is that if the market trend is working in your favor, keep selling credit spreads as it moves lower and lower and lower, or higher and higher and higher if you're bullish on it, because you want to keep collecting premium. And the question is just, at what point do you manage these trades? At what point do you roll these trades? These are the rules for going about doing so. Does that make sense? Please type 6 into the chat window if that makes sense to you. And the last part, if you have a credit spread that's approaching 21 days to expiration and it hasn't hit your stop loss or your take profits, time to also think about rolling your credit spreads, because when you get into that last 3 weeks, that short call or put that you have is at higher risk of being assigned early. You don't want to be long or short 100 shares of that stock for every contract. Don't get yourself caught in that position. That's why we don't sell 1 week credit spreads, because if you sell 1 week credit spreads, you're very likely going to end up in a position where you're going to be long or short the stock. You don't want to be in that position. You may not even have the margin to be long or short that particular stock, and your brokerage firm is going to liquidate you from that position. That's why we don't sell 1 week credit spreads, because of the elevated risk that you're taking when you're selling credit spreads that are so close to expiration as an option seller. Does that make sense? Please type 7 into the chat window if that makes sense to you. So the OptionsPlay tool also makes it very clear how many days to expiration you have left on your credit spread. So Baidu still have 29 days left. We haven't reached our take profit, haven't reached our stop loss levels. It's still okay to maintain. But if that starts reaching 21 days to expiration and I'm still in this 65% range, I'm going to consider getting out of that trade or adjusting to balance out my risk of the overall portfolio. Okay, so that's how you manage the credit spread. So I have a cheat sheet here, which I will send out with the slides for those of you that want to review the details of when to trade a debit spread, when to trade a credit spread, what are kind of the best practices for each one of these strategies. So that concludes what we wanted to show you here today. So today, what you learned is leveling up from singles to doubles. In my opinion, that's the largest incremental gain that you're going to get as you go from single leg to multi-leg, is going from singles to doubles. Next week, we're going to talk about going from doubles to 3 to 4 legs. But I will admit that comes with a lot more complexity, going from 3 to 4 legs with a much smaller incremental gain. So the biggest kind of gain that you're going to get is going from singles to doubles. But next week we are going to talk, for those of you that want to learn more, how you can go from doubles to 3 or 4 legs, what incremental gains you get, and also what complexities you end up adding when you do add those 3rd and 4th leg. And the last session, I'm going to focus on growing your account. Like I said, our education is focused on rounding out your education, not just focusing on one thing, but how can you become a sustainable and confident trader in the long run? Most importantly, how can you grow your account in the long run? If you're not growing your account, doesn't matter how well you know debit spreads and credit spreads and iron condors and butterflies. If you're not growing your account with it, the knowledge is useless, right? So my goal here with the OptionsPlay education is to make sure that you have everything that you need beyond just the technical, the options trading, but also kind of how do you manage your account so that you can actually have the emotional resilience to stick to your trades, stick to your plan, and actually get to that profitability part. And that's what you're going to round out in the last session. So I really hope that you'll be able to join me through this whole journey and making sure that you have everything you need to be a profitable trader in the long run. So just a reminder here, if you want access to today's recording, you want access to the cheat sheet, you want access to, the outcome slides that I kind of went over a little bit, sign up for your free trial at optionsplay.com/sign up, or point your phone to the QR code. If you are a member or you're currently on your free trial, you will get access to the recording and slides already. You obviously already have access to the platform if you have a free trial or you have a subscription to OptionsPlay. But for those of you that don't, if you want to use the platform that I showed you today to structure these trades, to track them in your paper trading portfolio, to sync up with your TD portfolio. And like I said, Schwab is coming down the line. Just sign up for your free trial and you'll be able to have access to everything on your screen. So with that, let's go over to the Q&A section of the segment. Now, I saw a lot of questions in the chat window during the session. Please type your questions into the Q&A window. There's a Q&A window and a chat window. Type your questions in the Q&A window. I'll try to answer as many questions as possible before I have to sign off here in a few minutes. Okay. Do you exit a debit spread at 21 days to expiration? No, because you are long the option, you have the right to exercise that call. You don't have that same risk that you have when you're short the option. So you don't have that time element when you're long the option as you do when you're short that option. What's the difference between strength versus momentum? Momentum is measuring kind of how a stock is performing relative to itself. Strength is measuring how the stock is performing relative to the rest of the market, right? So the 1 month and 6 month trend gives you a sense for how is the stock trending relative to itself. Relative strength tells you how it's doing relative to the market. So even though Apple is trending lower, it's still outperforming the overall market. So maybe when the market drops 2%, Apple only drops 1%. That kind of gives you a sense for strength. Michael, so Michael's asking, in the Starbucks example, selling the naked call gives you the highest OptionsPlay score. Why don't you recommend it? So I've spoke about this, Michael. Selling that short naked call requires a hell of a lot of margin and takes on unlimited risk. Like I said, you've seen what happens with GameStop when you're short the stock, right? And you have truly unlimited risk. I never want to put any options trader in that position. I certainly don't want to ever be in that position myself, which is why I don't recommend selling the naked call. You're better off taking on a little less income, a slightly smaller return in exchange for having full control over how much money you can lose. What's your view on selling credit spreads that are more out of the money instead of replacing the 0.2 delta rather than the 0.5 delta? So John, there's nothing wrong with selling out of the money credit spreads, but it's more of what we call, I don't love the expression. The expression that traders use is picking up pennies in front of a freight train, right? Because the risk to reward on those trades are very, very poor. you're collecting a lot less income in exchange for a lot more risk, right? And so always these black swan events, things that you don't anticipate that's going to happen, that kind of really puts those strategies behind. The success of low delta out of the money credit spreads is heavily contingent upon when you start. And that's purely just based on luck, right? If you started these types of strategies in 2010, you would have been wildly successful. But if you started selling out of the money credit spreads in 2020, then you would have potentially lost a lot of money from the very beginning and had a tough time getting yourself back to break even. And that was purely just luck as far as when you started the strategy and kind of what the market is doing at the time. So from my perspective, I'm not a huge fan of it from that perspective, where you don't have full control over kind of when the market makes big moves that cause you to have these large outsized moves. And it's much harder to have losses at 100% loss when you're selling these out of the money credit spreads. You have to have much wider stop loss levels when you're selling far out of the money credit spreads. How do we sell a stop loss? How do we set a stop loss order for credit spreads? That varies by brokerage firm. So call your brokerage firm, tell them I'm selling a credit spread. I want to place a stop loss order. Have them walk you through it. It's very, I would say, different from broker to broker. The free trial is for 30 days, Charles. For those of you that want to, do stop loss orders on debited and credit spreads or OCO orders, I actually have a video on our YouTube channel specifically on how to do it for Thinkorswim. Thinkorswim is actually one of the only platforms that allow you to enter an OCO order for your credit spreads and debit spreads that's good till cancel, which is why I have a video specifically on Thinkorswim on how to do that. Otherwise, most brokerage firms don't support that. So again, different brokerage firms, different order types. Call your brokerage firm, understand what they offer before you place them. I've noticed all your daily play trades are spreads as opposed to the wheel strategy. Great, Neil. Thank you so much for that insight. Yes, the daily play is for trading, right? But we're actually in the process of about to launch kind of a wheel strategy newsletter, the same way we offer the daily play. So, we're probably a couple of weeks out from launching that as well, because a lot of you are interested in the wheel strategy. You're long-term investors. You want to see how short puts and cover calls can help you enhance your portfolio. We're in the process of actually launching a wheel strategy focused newsletter, the same way we have the daily play for our members. There's a question, you're a member and you want access to the recordings, please send us an email at info@optionsplay.com and we're happy to point you to where those live. I don't believe you can do an OCO order on Fidelity in my, you can only do one side of it. Carol, when you say, can I talk about strategy and choices? What do you mean by choices? How do I come to that particular choice? If you don't mind explaining that, that'd be great. And for those, there's quite a few questions here asking, what kind of courses we offer. Send us an email at info@optionsplay.com. Like I said, if you have a free trial, you have a membership, we have tons of courses that are available to you as a member. So, sign up for that free trial, reach out to our team, and we'll be able to point you in the right direction. Does the tool have scanners and suggestions for daily play? Absolutely. If you look at the idea section, you have technical based ideas. So those are just based on the underlying security, bullish and bearish ideas. You have cover call ideas, you have credit spread ideas, and you have short put ideas. These are all kind of different, whether you're looking for ideas on the underlying stock or you're looking for ideas that are already optimized for you from an options trading perspective. The credit spread is one of the most important ones that I use day in and day out to find opportunities to trade in my own portfolio, to trade in the daily play portfolio. This is how we find opportunities to kind of collect as much premium as possible on credit spreads. So this is all integrated into your platform under the ideas section. Like I said, you have technical ideas and ideas that are based on options ideas as well. If we have a debit spread and it's not moving in any direction, how soon should we close it out to avoid further time decay? Jay, that's a great question, right? Like I said, I tend to find that 50% rule is, if you need just a hard and fast rule of thumb, that 50% rule is a pretty good starting point. Because once you reach that 50% loss, chances of that stock coming back and getting back to a gain is less than 30%. Under 50%, you still have a 50-50 shot that trade at least comes back to break even. So, which is why, we use that 50% rule when you're trading a debit spread. Please explain how earnings or dividends affects options. Gerald, we actually have a course on option pricing. That's a pretty complicated topic in itself. So I suggest that you just go to our YouTube channel, watch our video on options pricing that kind of and shows you how earnings and dividends affects an options price. But like I said, there's a lot of input that go into an options price, and that is a slightly longer discussion than just a 10-15 second answer, unfortunately. How about a wide credit spread? So it plays like a naked call, but limits your risk somewhat. Patty, absolutely, right? This is kind of, think of this as a foundational course, right? And Patty, what you're suggesting is a great example of clearly you've understood the foundations of those 4 core strategies, that you actually feel comfortable enough to make variations of what we're showing you. And as long as you understand what the trade-off that you have, what those variations are, sounds like you're on the right path, Patty. Trading a wider call spread, a wider credit spread will give you a risk profile that's similar to the naked call, but you take on a little bit more risk in addition to doing so, right? But you don't have unlimited risk. Perfect example of Patty, someone who's clearly understood the foundations and is now able to apply those foundational concepts to trading these multi-leg trades and actually make some variations based on her own needs in this particular case. So fantastic application, Patty, and I think that's what you're suggesting makes perfect sense if you're willing to take on the additional risk so that you get something closer to that naked call or put. When should we buy a stock when it's in pullback? What percentage should be? Generally speaking, I don't think percentages work for the most part because 5% for Apple is very different from 5% from Palantir, right? You kind of have to look at the overall chart. Also, technical indicators are a good way to kind of normalize percentages and tell you roughly when it's time to be buying, right? You look at some of the popular indicators. I use commodity channel index. You can use CCI, you can use MACD. Any of these indicators give you a sense for when things have pulled back enough to warrant potentially, from a statistical perspective, to be a buyer. When is the future of Charles Schwab sync expected? I think the first tranche is starting to move over in November and into kind of mid 2024. So most clients from TD will be moved over from TD to Schwab sometime between November and May of next year is what's been communicated. Michael, you're saying you're a member, how to get access to slides and resources. Number one, they'll automatically be emailed to you once we finish processing the recording and the slides. But if you don't get that, feel free to reach out to us at any time at info@optionsplay.com, or simply just click on the Ask Us button here on your platform and say, hey, I just attended yesterday's session. I didn't get the recording. How can I get it? And we'll send it to you. How do you link your TD Ameritrade account to OptionsPlay portfolio? When you go to your portfolio tool, there's a little manage button here on your portfolio tool. If you click on it, you can select your brokerage account and click on sync. and that will start the process to sync up your TD portfolio with OptionsPlay. And what you'll get is you'll basically be able to pull up your TD portfolio within OptionsPlay and see, as you can see, these are all the positions that I have within my portfolio that are synced from my TD account. You generally do have to have a margin account to trade spreads. Okay, with that, that covers all the questions that I have time for here today. Thank you so much again for your time. I hope that you guys find this useful. And like I said, for those of you that are brand new to OptionsPlay, if you want access to the slides, the recording, and the platform that I showed you here today, start tracking your portfolio and setting up these types of debit and credit spreads, please sign up for that free trial at optionsplay.com/sign up. And I'll leave this up on the screen here for a few seconds for anyone who wants to sign up, or point your phone to that QR code. Have a great trading week, and I'll see you guys on Monday on our Monday macro session.